you want to know where your money is actually working for you in 2026, this is one of those topics that quietly separates people who grow wealth from people who just save money and hope. Because here's the truth most people miss. Saving money is not the same as growing money anymore. Let's break it down. If you walk into a bank today, any bank really, and ask about savings interest rates, you'll hear numbers that sound fine at first. Safe, stable, familiar. But when you compare them to inflation, fees, and how fast the world is changing financially, you start to realize something uncomfortable. Your money might be sitting still, while everything around it is moving faster. And in 2026, that gap matters more than ever. So the real question isn't just which bank pays the highest interest, it's this. Which banks and savings options actually help your money keep up with real life? Let's talk about that. First, you need to understand how savings interest works in today's world. When you save money in a bank, the bank is basically saying, "Thanks for letting us hold your money. We'll pay you a small reward for it." That reward is your interest rate. But here's where it gets interesting. In most traditional savings accounts, the interest rate is usually low. Sometimes so low that it barely feels like anything is happening. And the reason is simple. Savings accounts are designed for safety and liquidity, not high growth. So banks keep rates conservative. But in 2026, things are shifting. We're seeing more competition between traditional commercial banks, digital banks, and fintech platforms, high-yield savings products, money market-style savings options. And that competition is slowly pushing better returns in some places. Now, let's talk about the big picture trend you should notice. Across many regions, especially emerging economies and even developed financial markets, interest rates have been fluctuating because central banks are constantly adjusting to inflation and economic pressure. What does that mean for you? It means savings interest rates are no longer fixed expectations. They move, they change, and they depend heavily on where and how you save. So if you are still treating all savings accounts as the same thing, you're already behind. Now let's get practical. When people ask which bank gives the highest savings interest rate in 2026, the real answer is not one bank. It's a category difference. Let me explain. 1. Traditional banks. These are your standard commercial banks. They are strong on trust, regulation, safety, but they usually offer lower interest rates, slow adjustments to market changes. So your money is safe, but growth is usually modest. This is where most people keep their emergency funds, and that's fine. But it's not where you go to maximize returns. 2. Digital banks and fintech savings platforms. This is where things start to get interesting. Many digital financial platforms now offer higher interest rates than traditional banks, flexible savings plans, automated saving features, sometimes daily or weekly interest calculations. Why are they able to do this? Because they have lower operational costs and often invest pooled funds more efficiently within regulated financial instruments. But here's the important part. Higher interest often comes with trade-offs like limited physical presence, dependence on app-based access, varying levels of regulatory strength depending on the country. So you're trading convenience and sometimes higher returns for a different kind of banking experience. 3. Money market and investment-linked savings. Now this is where many people get confused. These are not traditional savings accounts in the simple sense. They often invest your money in treasury bills, government securities, low-risk financial instruments. Because of that, they often offer better returns than standard savings accounts, but slightly more variability in interest rates. Think of it like this. Not risky like trading, but not as static as a savings account either. This is often where people start to see their money actually doing something meaningful. Now let's pause on something important. A lot of people chase highest interest rate like it's the only thing that matters. But in real life finance, that's a mistake. Because the real question should be, after inflation, after fees, after access restrictions, how much am I actually gaining? A bank can advertise a high rate, but if inflation is higher than that rate, your purchasing power is still dropping. So you're not really growing wealth. You're just slowing down loss. That's a mindset shift most people never make. So how should you actually choose where to save in 2026? Let's make it simple. Instead of looking for one best bank, think in layers. Your safety layer, a stable traditional bank. Your growth layer, a higher yield digital or money market option. Your liquidity layer, money you can access instantly for emergencies. This way, your money has structure instead of sitting in one place doing nothing. Now, here's something most people don't realize. Banks don't just compete on interest rates, they compete on behavior. Some banks want you to save more frequently, keep money in the account longer, use automated savings tools, because when your money stays longer, they can invest it more effectively. So sometimes the best rate is also tied to how you behave as a saver. That's why you'll see bonuses for locked savings, fixed deposits, goal-based savings plans. They are basically rewarding discipline. Now let's make this real for you. If you're someone trying to build wealth in 2026, here's the honest truth. Your savings account is not your wealth engine. It's your stability tool. The real growth comes from investing, skill income growth, smart allocation of savings into better yield instruments. But without savings discipline, none of that works properly. So savings is still important. Very important. Just not in the way most people think. Before we wrap up, let's bring it back to the main idea. If you remember nothing else from this, remember this. In 2026, the difference between financial stagnation and financial growth is not just how much you earn. It's where your money sleeps when you're not using it. If it's sitting in a low-yield account for years, you're quietly losing value. If it's placed strategically across different savings options, you're giving your money a chance to keep up with the real economy. So instead of asking, which bank has the highest interest rate, start asking, which structure helps my money grow safely while still staying accessible? That one question changes everything. And if you're serious about improving your financial position this year, don't just look at numbers. Look at systems. Because in the end, wealth isn't built by one perfect decision. It's built by consistent, informed ones. And your savings strategy is where that consistency begins.